The market cycle. We've been here before. The iconic stock market speculator Jesse Livermore. There is nothing new in Wall Street. There can't be because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. This not only applies for stock speculation, but also to our overall economy. You're going to see three examples of how macroeconomic history is repeating itself and exactly how relevant this data is today. Based on these repeating patterns, we might just be able to anticipate what could happen next. Here's our first example: divergence between stocks and bonds. In yellow, S&P 500. In blue, US 10-year Treasury yields. Typically, we expect the stock market to move in the same direction as Treasury yields. However, as a result of last Friday's bleak jobs number, stocks are rallying in anticipation of lower interest rates sooner than expected. In blue, 10-year US Treasury yields sink as Treasury yields ultimately follow Federal Reserve futures and the anticipation of lower interest rates. This is not the first time it happened, though. Go back to the days of 2007, specifically in October. In yellow, S&P 500 rallying, while at the same time, 10-year U.S. Treasury yields begin to sink in anticipation again that the Federal Reserve would lower interest rates. We also see something quite interesting: market rallies on bad news. It's counterintuitive. We see here in white, S&P 500 non-farm payrolls are shown with the histogram bars. Last Friday, 175,000 new jobs were created. That was certainly not a good number. Again, as a result of the bad news, the market is now anticipating we're going to see lower interest rates sooner than we expected. Well, we see stocks are moving under bad news. Typically, we'd like to see stocks and we'd expect to see stocks move up under strong jobs numbers. Strong jobs numbers are usually indicative of stronger corporate earnings, but now the stock market is focusing on future interest rates. Not the first time it happened, though. Go back to October of '07, and we see here non-farm payrolls, only 72,000 were reported that month. At the same period of time, stocks rallied again in anticipation of lower interest rates. Our third example in just a moment. Quick sidebar: Fed funds futures in blue, the probability the Federal Reserve will not cut rates. In green, quarter point cut. In red, the probability of a half a point cut. Now we're calling September our pivot point. That is the moment in time when we expect the Federal Reserve to cut rates more so than to leave rates unchanged. In September right now, there's a 36% chance the Federal Reserve will not cut rates, a 48% chance of a quarter point cut, 15% chance of a half a point cut. Here's what's interesting. In the November meeting, there's only a 22% chance the Federal Reserve will not cut rates. There's a 28% chance that interest rates will be down half a point from where they are now. There's a greater probability that we'll be down half a point in interest rates by November. And that is really something that's new, again, as a result of the very bleak jobs number we received last Friday. Our third example: inflation surging over jobs. In red, CPI, Consumer Price Index, that's our measure of inflation. Histogram bars show us the non-farm payroll number. And what we see as of late, inflation is not only sticky, it's actually starting to rise, while at the same time, non-farm payrolls are falling. This is not really a situation we want to find ourselves in, with rising inflation that's preventing the Federal Reserve from cutting rates, but falling jobs. Now, Federal Reserve did say during their last meeting that they would not cut rates unless the jobs market really started to fall apart. Unfortunately, at least by this data, that looks like the direction we're going. Not the first time it happened. Go back to the 2008 period of time, and we can see here surging inflation. At the same time, the jobs market really fell apart. The Federal Reserve found itself in a similar dilemma. Now, speaking of the jobs number, we saw last Friday 175,000 new jobs were created, but that was not the only data we looked at. There was also the JOLTS report, the ADP report. In particular, we found three key signs that the jobs market is actually a lot worse than most of us think. And these are numbers that most of the economists out there are just not talking about. I think that you're going to find what we discovered to be quite interesting.